Hello folks, I'm John Najarian, and here's what's going on with gold. Of course, the precious metal was just slammed at the end of the second quarter. We talked about some of the factors that might have weighed into that. Things like funds that were exiting the precious metal going into the end of the quarter that didn't want it on their sheets. Well, you had many investors, of course, who were also scared out of that commodity. Now it seems things have turned for the better if you're a holder of gold like me. As I said, at the end of that quarter, I bought both physical and the futures that trade right here at the world's busiest commodity exchange. I'm, of course, here at the CME Group. And the futures for gold peaked, of course, in 2011 at about $1,900. I want to make sure, $1,924 to the ounce. That was in 2011. It's been a while since gold was that much in demand, but nonetheless, I think it could be having a resurgence at these levels. We've seen it trade all the way down to about a level of, let me see, 1179. That's 1179. That's, of course, where gold bottomed basically at the end of June. Again, that was that flush that we were looking for. You can see it in volumes of trade. If you go on the CME's website, you can click on metals and you can see the volumes on any day. You can see the volumes of trade per month of the futures, or you can look at, of course, charts from the site. We're pulling some of those up for this video as I speak. And I think gold down there below 1,200 to the ounce was a steal. Now here's another indicator of that. The volatility metric for gold, which is GVZ. Now that's volatility, which is how much that given commodity or asset might move on a given day. Some people refer to it as the fear indicator. I refer to it as more or less the expected movement indicator. So it's not always fear, because sometimes you can see volatilities go up when the market's going up if you have a lot of shorts. I think you did catch a lot of folks short gold at the end of June. And then as we began July and we started to get a little different rhetoric out of the Fed, we saw a dramatic turnaround. The GVZ, again, that volatility for gold, came down from a reading of about 34 right at the end of June to readings today of about 23. Now that's a dramatic drop, folks, an 11-point drop. As you might imagine, that impacts the price of those calls and puts for gold. Now, to give you a reference point, the S&P 500 VIX, which is, of course, expressed as VIX, that is right around 1389. So it is basically 9 full points under where gold is right now. So they're saying that gold is far more volatile. In other words, gold could have much wider swings on a daily basis than we could see out of the S&P 500. Now, one of my favorite ways to trade it right now, beyond just the miners and the futures that trade here at the CME, is to trade a levered ETF product like NUGT, N-U-G-T. NUGT is the Direxion triple-weighted ETF for gold. So when you're looking at this one, folks, on a daily basis, it's going to move 3 times as much as gold. So on today, the 16th of July, I see this contract moving by better than 12% today. You can imagine what the volatility must be when you have a contract that can swing that wildly and see a 12% move. You were basically buying it, as I was, just a day and a half, 2 days ago, for instance, last Friday, at the 570 level. That's $5.70, and it explodes through 6 to the upside, as I say, making a 12% move today. Dramatic moves out of the physical as well as the futures, and the options are expressing that people look for continued volatility. That could be up or down, but my bet is we continue to trade up. I'm Dr. J from the CME Group here on July 16th.